Today, we're going to talk about something that might just change the way you think about money. We're going to dive into how even a small, consistent investment can totally reshape your financial future. And here's the secret. It's not about having a ton of cash to get started. It's about starting with what you've got and letting a really powerful force do all the heavy lifting for you.
And isn't that the truth? $100, it doesn't feel like much, right? That's maybe a nice dinner out, a new pair of shoes, a few streaming subscriptions. In the grand scheme of things, it feels like a drop in the bucket when you're thinking about building real, lasting wealth.
But what if we've been looking at it all wrong? What if the real secret isn't about the size of the check you write, but about the rhythm of your investing? We're going to shift our focus from the amount of the investment to the power of the habit. And honestly, that one little shift is what separates the people who build fortunes from those who just wonder where all their money went.
So let's talk about the $100 problem. Why is it so hard to just start small? Well, a lot of it comes down to psychology. We're kind of wired to look for the big, flashy wins, and tossing $100 into the market just doesn't feel like it's going to move the needle.
Just look at this breakdown of the beginner mindset. On the left, you've got the common belief. I need to find the next big thing. Get rich quick. It's all excitement and adrenaline. But the reality? It's over there on the right. Wealth isn't built on excitement. It's built on, boring repetition. Brick by boring brick.
And this is so important. The biggest mistake you could make isn't starting with a small amount. Not at all. It's getting discouraged and quitting too early. People get all fired up for a few months, they don't see those crazy returns they dreamed about, and they just stop. They never give their money a real chance to get to work.
Okay, so if consistency is the key, what's the engine that actually drives all this growth? Well, that's where compounding comes in. You've probably heard the word thrown around, but do you really, truly get what it means? It's basically your money making more money. It's the powerhouse that turns your small, consistent contributions into something seriously big over time.
I love this analogy because it makes it so clear. Think about it. Your first $100 is like a single seed. You plant it, it grows into a tree and gives you some fruit. Those are your returns. But here's where the magic happens. Inside that fruit are more seeds, so you plant those too. And soon enough, you're not just growing a tree, you're growing an entire orchard. That's exactly what compounding does.
And this is where it gets really, really cool. Look at these numbers. After 10 years of putting in just $100 a month, you'd have about $18,000. Not bad, a great start. But the real explosion happens in the next couple of decades. By year 20, you're up to $58,000. And by year 30, you're looking at almost $150,000. That exponential leap, that is compounding in action.
So the big question is, how do you actually stick with it long enough to see that kind of crazy growth? The secret is to take your own emotions completely out of the equation. You need a system that just works for you without you having to think about it.
The strategy for this is called dollar cost averaging. Now that sounds like a fancy, complicated term, but the idea is incredibly simple. You just invest the same amount of money on a regular schedule no matter what the market is doing. So when the market's down and prices are cheap, your $100 buys more shares. When prices are high, it buys fewer. It smooths out the ride and stops you from trying to guess the market, which, let's be honest, is a losing game.
So how do you actually do this? Well, instead of trying to be a genius and pick the next hot stock, you can just buy something called a low-cost ETF, or exchange-traded fund. The easiest way to think about it is like a basket that holds tiny little pieces of hundreds of different companies. A classic example is an S&P 500 ETF. That gives you a tiny slice of the 500 biggest companies in the US. Then, you just set up an automatic transfer from your bank account. The goal is to set it, forget it, and just let time do its thing.
All right, so you've got the plan, automate your investments into a simple ETF. Awesome. But what if I told you there's a tiny little adjustment you could make that would make that plan even more powerful? We're talking about how often you invest. And believe me, it matters way more than you'd think.
So, to illustrate this, let's meet Alex. Alex is 25, just getting started, and really wants to build some wealth. So Alex decides to run a little experiment for us, comparing two different ways to invest the exact same amount of money. Okay, here's the setup. On the left, Alex invests $100 every month. On the right, Alex invests $25 every week. Now, over 10 years, the total amount invested is exactly the same, 12 grand. But just look at the final balances. The weekly strategy ends up with over $1,000 more. That's a pretty big deal for such a tiny change.
Let that sink in. An extra $1,075. That is basically free money. You didn't take on more risk, you didn't have to find a better investment, you just changed the timing. That is a serious boost from one simple little tweak.
So why does this work? Well, the reason is actually beautiful in its simplicity. When you invest once a month, your money sits on the sidelines, on average, for about 2 weeks before it actually gets put to work. But when you invest weekly, your money jumps into the market almost right away. This gives it more time in the market, which gives that compounding effect a little head start, week after week after week. And over a decade, those little head starts really add up.
Okay, so let's fast forward 10 years. Imagine you open up your investment app and you see that balance. It's gonna feel great. But I'm telling you, that number on the screen, it isn't even the most important thing you've built.
This quote really hits the nail on the head. Every time you make one of those small investments, you're not really just buying shares in a company. You're buying your future freedom. You're buying options. You're buying yourself time and breathing room down the road.
Because after a decade of doing this, the most valuable thing you have isn't the money in the account. It's the habit you've built. It's the new identity you've created for yourself. You've proven that you can be consistent, that you can be disciplined. You've become an investor. And that momentum is what's truly going to change your life.
So that's really the final question, isn't it? A decade from today, you're going to look back, and you'll either be the person who looked back and said, "I'm so glad I started then," or you'll be the person who decided to wait just a little bit longer. The difference between those two people isn't just about a few $1,000s. It's about the entire trajectory of your financial life. The choice is yours.